Hello and very warm welcome to the channel of Victory IAS. So we are doing 2 years rapid revision current affairs series for economic updates also. So let's dive into the topic of RBI related updates that were there in the news with respect to current updations. So let's understand. RBI releases final guidelines for fintech SRO, financial technology firm related to technology in financial transactions and all. The RBI finished the rules of setting up a self regulatory organization SRO, self regulatory organization, growing fintech industry in 2023. This is better than the draft guidelines that were first suggested in January. After hearing from people in this business, the RBI wants these SROs, that is self regulatory organizations. That means some regulatory authorities will not be there. RBI will be having some overlooking roles. That's it. Will be placed new places where different players in the fintech industry besides banks can go to the regulated and represented. Who does it cover? So SRO is meant to cover a wide range of fintech activities such as digital loans, peer-to-peer services and accounts aggregators, right? For example, we have seen payment aggregators as well in this regard. It's important to note that the SROs urge both regulated and mostly unregulated fintech companies to join. The goal is to include wide range of industry players to make sure that there is full oversight and inclusion, because we have seen there were many apps related to giving loans digitally, and then we have seen harassment of the people accessing to their contacts, accessing to their galleries, photos, etc. So that is why we are having this SROs, which can include the regulators, which can include everyone that is there in the economy with respect to regulators, right? The RBI has set out some important duties for the SRO, such as representing the fintech sector, keeping data safe, following development principles, setting disputes, right, if there are disputes arising from it, so some grievance redressal mechanism, etc., making sure members follow the rules and staying separate from outside influences. In addition, the SRO is in charge of controlling risk that could hurt users, like fraud, mis-selling and transactions that aren't supposed to happen, that kind of thing, right? Enforcement and monitoring, if we talk about guidelines, stress how important it is for SRO to effectively oversee and police the rules. This means coming up with basic rules and guidelines for behavior, as well as strong ways to keep eye on people and make sure they follow these rules. These things are there. Multiple SROs and membership. RBI has allowed the creation of various SROs because it understands that the Indian fintech landscape is diverse. Every financial company needs to be a part of at least one SRO. Because of this, fintech companies can pick an SRO that fits their goal and business models well. So that kind of regulation can be there. RBI approves highest ever dividend of rupees 2.11 lakh crore for the government. Now it has been in the news in past also because of its nature. The nature here is for example related to the kind of dividend that RBI has to share with the government. Now it remains in the news because sometimes RBI resists also, right? So RBI has to share some of its dividend with the government, right? A record amount of 2.11 lakh crore has been approved by the Central Board of Reserve Bank of India as the surplus payment to the central government for the accounting year 23-24. This large transfer goes above and beyond what was planned in the budget and what the market thought would happen. It sets a new standard for the RBI's financial payment to the national treasury, means the dividend has been shared with the government. Comparison with the previous years and market expectations. What were the market expectations? That how much government will be transferring to them, how much RBI will be transferring to the government, and what has been the history of such contribution. On past data and what market thought would happen, the surplus shift of this time period was thought to be around 1 lakh crore to 1.1 lakh crore. And how much it has happened? 2.11 lakh crore. So almost double of the estimation. So the allowed amount is twice what was expected, and big jump of from previous years. The transfers of 87,000 crore in 22-23, 30,000 crore in 21-22 show how different the two amounts are. This sudden rise in surplus transfer will ease fiscal pressure. Why we are talking about fiscal pressure here? Because it is the fiscal deficit of the government. When we talk about fiscal deficit is nothing but expenditure of the government minus the revenue, expenditure minus revenue. And when government is receiving dividend from RBI, it is enhancing its revenue, so fiscal deficit will be less. That is why we are saying fiscal pressure will be released or ease, which could lower the fiscal deficit for the year 25 by around 0.2% of GDP. According to the interim budget, the government wants to cut the budget deficit from 5.8% of GDP in financial year 24 to 5.1% of GDP in financial year 25. This new development helps them reach their lofty goal, right, of this reducing the fiscal deficit or debt to GDP also. Factors contributing to surplus increase, several things have led this huge cash gain. The RBI's income from variable repo rate. Right now RBI has gone for variable repo rate. Sales has gone up because more people are taking part, even though banks are having trouble getting cash. The RBI's earning have also been helped by higher interest rate on both domestic and foreign securities and gain from revaluing foreign exchange funds, right? More about RBI surplus transfer. If you want to understand more or want to dive deeper, surplus transfer to the government, the Reserve Bank of India annually transfer its surplus, which is essentially the central bank's profit, to the government. This surplus primarily comes from the interest on loans and securities held by the RBI, because RBI is holding a lot of lot of government bonds as well, foreign bonds, etc. Also, Bimal Jalan Committee's recommendation. Now, in this regard, Bimal Jalan, the former RBI governor, has recommended many things so that the smooth transition or smooth transfer can happen between RBI and the government. The distribution of the surplus follow the guidelines set by the Bimal Jalan Committee, which reviewed and revised the economic capital framework in 2019. The committee's recommendation aimed to balance the RBI financial resilience with the fiscal needs of the government. So, if RBI is not transferring to the government, then RBI fiscal resilience will increase, but that should be a balance between RBI financial resilience and the fiscal needs of the government. Now, the impact on fiscal deficit we have already discussed. Impact on fiscal deficit may get decreased. More about variable repo rate auctions. We have already seen central banks like the Reserve Bank of India use variable repo rate bids to control the amount of cash in the banking system. The repo rate, which is the rate at which private banks borrow money from the RBI, or private banks, or for that matter commercial bank, can change during this auction, which is different from fixed repos, right? That is why variable repo rate, and RBI has increased their profits. The times between VRR sales can also change, so this is related to variable repo rate. One of the tool for monetary policy. Now, RBI at 90. The Prime Minister addressed the opening ceremony of RBI at 90 in Mumbai, marking 90 years of the Reserve Bank of India. RBI has been established by RBI Act 1934. RBI Act 1934, and this got established by established by the year 1935, right? 1935. But please understand one thing, that the regulation power comes from Banking Regulation Act 1948. Banking regulation, the regulating power that the RBI is having comes from Banking Regulation Act 1948. Right, this is the idea here. So, Royal Commission of Indian Currency 1926, Hilton Young Commission recommended the establishment of the RBI, a suggestion reiterated by the Indian Central Banking Inquiry Committee in 1931. RBI was founded in 1935 under RBI Act 1934, with Sir Osborne Smith serving as its inaugural governor. Sometimes question here and there can be there. 1949, RBI was nationalized, marking the pivotal moment in its institutional history. The Reserve Bank of India has evolved significantly in recent years. For example, inflation targeting, central bank, we have already seen this monetary policy committee is under RBI, which has the target of inflation, for example 4% plus minus 2%. We have already seen this 4% plus minus 2% is the CPI combined that they talk about. CPI combined. There are many others, CPI urban, CPI rural, etc. So many other parties also there. Foreign exchange reserve. RBI is the custodian of foreign exchange reserve. RBI is the custodian of Forex Reserve. RBI is the custodian of Forex Reserve. So it is mainly the role of macroeconomic stability. I have already explained you in one of the videos. Macroeconomic stability, when we say, there are four things, right? Controlled fiscal deficit. There are four things: controlled fiscal deficit, controlled current account deficit, controlled current account deficit, controlled fiscal deficit, controlled inflation, and sustainable growth. These are four macroeconomic stability dimensions. Sustainable growth, right? Then reduction in non-performing assets, NPA, non-performing asset, technology in payment, central bank digital currency that RBI has come up with, CBDC, also known as this e-rupee, that is CBDC. However, the RBI faces several challenges as well. Number one, banking regulation and supervision. RBI faces challenge with respect to this. That is why we have seen RBI has also come up with this asset quality review program. During many a times, but we have seen during Raghuram Rajan, when Dr. Raghuram Rajan was the governor of the RBI, then AQR program was implemented, and then we came to know how much NPA have already been piled up by the banks. Transparency with the regulated entities, regulating new age fintech firms, etc. These are challenges. Limited powers over public sector banks, because the government is the owner here and public sector banks enjoyed some autonomy here. Potential fiscal dominance of monetary policy, India's coal and lignite production, etc. India's coal and lignite production reached now this is new topic. India's coal and lignite production. Coal and lignite production reached an unprecedented milestone, surpassing 1 billion tons of fiscal year 23-24 compared to 937 million tons. This we will study under industry, so I am skipping this particular part here. Right now, RBI Governor unveils key financial initiative for 2023. So what would be the key financial study? Shaktikanta Das, as you can see in the photo, to make financial services easier to get and better what they do, RBI Governor Shaktikanta Das recently launched three big projects: the Prava site, the Retail Direct mobile app, and FinTech repository. We have already seen this, right? In the last video, we have already covered this, so not to go into details of this now. Front running, we have already seen what is front running, right? Maybe it is related to insider sales also. Sometimes broker is having extra information when the client is placing order for the number of shares that is to be purchased, and we have seen one employee from LIC got also the penal action was taken place against him. So SEBI has mandated asset management companies to establish an institutional mechanism to deter potential market abuse, including front running, following recent instances observed by the market regulator, that is SEBI here, right? So this is front running. We have already seen many this particular information. Asset management companies, we have already seen, which purchases what? Non-performing assets. Financial institution responsible for managing and investing pool from investors in various financial assets. Asset management companies, not asset reconstruction. It is not about NPA. For NPA, that is asset reconstruction companies, ARCs, asset reconstruction companies. Here it is AMCs, asset management companies. It is about the mutual funds mainly. We can say it is about mutual fund or the portfolios, etc., which are being made, right? So stock, bonds, other securities, they create a unit, and that unit is being sold to the people. These companies create and manage investment products like mutual fund, exchange traded funds, ETFs. ETFs like it is like mutual fund only, right? It is similar to mutual fund. For example, the Bharat 22 ETF. The government launched Bharat 22 ETF fund, exchange traded fund, where the shares of this public sector enterprises will be there. So 22 public sector enterprises were having their shares in Bharat 22 ETF, and pension funds. Other changes approved, that is amendment to SEBI Mutual Funds Regulation 1996 approved by the SEBI board, requiring AMCs to implement enhanced surveillance system and international controls on this to identify and prevent misconduct. That is there with respect to AMCs. Must also have a whistleblower mechanism. Whistleblower means going against the policy of the, maybe if wrong policies are being made or implemented, then a person from within the organization can raise their voice. That is whistleblower mechanism for transparency. SEBI will outline the framework, while the Association of Mutual Fund, that is AMFI, will specify detailed standard. Now this is what we have seen. Now this the pre-packaged insolvency resolution process, that is what we have already seen under Insolvency and Bankruptcy Code. Insolvency and Bankruptcy Code 2016 has given, for example, if a firm has taken loan and that become insolvent, then there are two parts of it. Either a resolution plan can be made and this particular firm can be bought by some another firm, right, resolution through resolution plan, or it can go for liquidation, or you can roll out the kind of assets that the company is having. So company may go for liquidation, firm may go for liquidation, as well as firm can have a resolution plan. Maybe you can restructure the loans, etc. That can also be there, but committee of creditors decide on this, right? Insolvency professionals, IP, and committee of creditors. So insolvency professional, they will be coming up with resolution plan, they will be preparing resolution plan, and committee of creditors with the vote of two-third vote, that is almost 67% vote is required that the resolution plan to be approved. If resolution plan cannot be approved, then the firm will be, or the insolvent will go for liquidation, right? So pre-packed insolvency resolution process is for MSMEs. That since more or less insolvent, these MSMEs are having low turnover, low investment, lower loan as compared to big industries. So the Insolvency and Bankruptcy Code has given a pre-packed plan, and pre-packed plan is known as what? Pre-packaged insolvency resolution process. Has successfully facilitated full settlement of operational creditors claims for 5 companies, right? So resolution process, this resolution process is a mechanism for resolving corporate insolvency that was added to the Insolvency and Bankruptcy Code in 2016, designed to be faster, more efficient than other process due to minimize disruption to business. Process involves preparing and negotiating a resolution plan before insolvency proceedings begin. Implement the plan immediately when insolvency proceeding starts, and completing the entire process within 120 days. Although we have seen that under IBC, if resolution plan and insolvency proceeding is going on, then 330 days are needed. But here 120 days you can finish the kind of things that are required there. Asset reconstruction companies, it is the companies we are purchasing, which are purchasing NPAs from the bank. So the RBI has raised supervisory concerns regarding the functioning of asset reconstruction companies. Now we have already seen, if asset reconstruction company is there, then RBI has also many a times revised the guidelines for the kind of capital base they should have, right? Now asset reconstruction company are financial institutions that acquire, these things we have already seen, acquire and manage stressed assets from bank and financial institution registered under Section 3 of SARFAESI Act 2002. ARC have several challenges, including issue like backdoor entry of defaulting promoters, lengthy settlement process, and non-transparent practices. Previously in April, RBI issued master direction for ARCs that we have already seen. Stipulates ARCs must contain a minimum capital requirement of 300 crore rupees, right, given until March 31st. So this we have already seen. Non-compliant ALC will face supervisory action, including the prohibition or incremental business unit compliance is achieved. ARC with minimum net owned fund of rupees 1000 crore, right, 1000 crore can act as resolution applicant permitted to invest in a specified instrument, right? This is the thing that we can understand. Now repatriation and disinvestment. If we talk about disinvestment, we have seen what is disinvestment. It is related to privatization, right? Now, when we talk about disinvestment and privatization, so disinvestment is about selling the shares of the government, right? Selling the shares of the government in state-owned enterprises. But when we talk about privatization, then there is a cap. We have to, when the government is selling more than 50% share and the managerial control is also getting transferred to a private business, then that is known as privatization, right? The recent decline in gross foreign direct investment is concerning, but equally worrying is the increasing pace of repatriation and disinvestment. Repatriation refers to the process of sending profits, dividend, or funds earned from investment in a foreign country back to the investor's home country, right? So foreign investors, if they are earning here and their profit is being shared to their home country, that is and disinvestment, we have already understood, involves reducing the liquidating investment in a particular asset or sector, typically by selling off shares or asset owned by a government, company, or individual. But more it is majorly talked about when it is government owned, right? Government is going for disinvestment. In fact, government also placed a target of 20,000 crore to be received from disinvestment, but it could not materialize. That is the different story, right? later government dropped the idea of disinvestment from the budget also. So you will not see that much disinvestment targets. Repatriation and disinvestment are concerning. Here we are talking about the private firms, where the firms from foreign, right? Here when we talk about this repatriation and disinvestment, it is basically foreign firms when they are having their shares in domestic firms, and when they are going for selling their shares, that is disinvestment. That is also a disinvestment here. And when they are taking back their profit, that is repatriation. Concerning because they indicate a withdrawal of capital from India, potentially undermining the positive impact of FDI inflows, right? Now if we talk about data, now each and every data need not to be remembered as it is, but you can understand that it is on declining trend, or that is what you can understand, the trend of the data, right? Here FDI, 46 FDI proposals were pending with 17 government departments for over 12 weeks. Gross FDI inflows fell by, so it has been reduced, fell by 16% to $71 billion in 22-23, with repatriation and disinvestment accounting for 41% of it. This trend rising steadily since 2001 to 2002 negates FDI positive impact, because when foreign companies are coming into our domestic country, they are coming up with their capital, they are also gives employment to the people, they also give the technology transfer also happens, right? So there are many benefits to it. But when they are taking their profit back, they are not investing in the business again, they are taking their profit back and they are disinvesting also, then that is negating the positive impacts of the FDI. This is what the overall crux of this. Into causes repatriation and simplification of procedures to retain and attract foreign investors. Now this is related to for FDI. Now we talk about government securities. The RBI has announced that the foreign portfolio investment FPI limit for investment in various securities will remain unchanged for the current fiscal year. The limit for FPI investment in government securities, when government is issuing a bond, and government that is considered as the safest investment, because government will not default on its bonds. If government is defaulting on its bonds, that is the least, or that is the worst situation that you can understand. State development loans and corporate bonds will be maintained at 6%, 2% and 15% respectively of the outstanding stock of securities. Government securities are tradable instrument, that means being traded in secondary market as well by government through auctions conducted by the RBI. They come into two types: short term, known as treasury bills, when it is for less than 1 year. It is also available for 14 days, 182 days, etc., with maturities of less than 1 year, and long term, known as government bonds or dated securities with maturity of 1 year or more. The central government can issue both treasury bills and government bonds. Treasury bills and government bonds both are same, government securities only, but treasury bills for less than 1 year and government bonds or dated securities for more than 1 year, while state government issue only government bonds, only known as state development loans, SDLs, right? Treasury bills, that means what inference you can draw from here is treasury bills or T bills can only be issued by central government and not state government. Central government and not state government. So state government cannot issue treasury bills, right? Cannot issue treasury bills. So this sometimes this kind of when we write and we cancel out, we remember in exam and we are able to mark answer correctly. Sovereign bond, also government bond only. Sovereign bonds means government bond. Yield of the bond, what do we mean by yield? So the gain that you will be having in by investing in this government bond or any bond, that is known as yield of the bond. Sovereign bond yields fell to near 1 year low following RBI's record dividend payout to the government. The 10-year benchmark yield crossed at 6.9%, its lowest since June 6, 2023. Expectation of lower government bond borrowing and improved fiscal deficit contributed to the decline. Additionally, easing crude oil prices and resumption of overseas investment boosted market sentiment. So bond yield, when it is decreasing, that means people will not be investing in those bonds because the returns are getting declined. Bond yield represents the return on capital invested in a particular bond. It is inversely related to bond price, right? If bond price is high, for example, this is how you can understand this. This is bond and this is the face value of it. Suppose the face value is 100, right? And the price of bond will not be 100. So the price of bond, suppose it is 80 rupees. 80 rupees, right? Price of bond is 80 rupees and the face value of the bond, that means after maturity you will get 100 rupees. Today you have to pay 80 rupees and suppose the bond will mature in 3 years later, then after 3 years you will be getting 100 rupees. So what is the yield of this bond? Yield is 20 rupees, right? In percentage also it is mentioned. So yield is 20 rupees. Now if price increase further, price becomes 80 to 90, then the yield of bond will become 10 rupees. So it is inversely proportional. If it is increasing, price is increasing, then yield is decreasing. That is why we say bond of price of bond and yield of bond are inversely proportional, meaning as the price of bond increases, the yield decreases, as I have shown you here, and vice versa. This relationship is crucial in the bond market, as fluctuation in the yield impact the attractiveness of the bond. If yield will increase, the people will be attracted towards bond. If yield will not increase, yield will decrease, then people will not be attracted towards bond. This is how you can understand. If price is increasing, yield is decreasing. Yield is the percentage income that investors receive from a bond. I have already told you bond interest payments are preset. So the less you pay on the bond, the higher percentage income those payments, right? I have already demonstrated this. Now a decline in government bond yields has a significant implication as it lowers borrowing cost across the economy, with sovereign debt yields serving as benchmark for the determining corporate borrowing rates, etc. So it is directly linked with bond yields or government bond interest also. Now the recent decrease in sovereign bonds can be attributed to record high dividend payout. This we have already seen. Dividend payout of 2.11 lakh crore by the RBI to the government of India, which is expected to bolster the government's financial position. Additionally, so government is having good financial position. That means that is why the yield of bond is less. Additionally, improved market sentiments due to falling crude oil prices has spurred buying interest in bonds, further contributing to the decline in yields. That is what it is there. Now nothing, this is not required this much. Exchange rates impact the economic volatility and inflation, etc. That is fine. Now when we talk about co-lendings, when many lenders are there and many lenders are extending loan to one particular borrower, that is co-lending. So the finance ministry has tasked SBI with forming a committee to address co-lending issue, aiming to boost credit flow. So if this becomes simpler, then more credit flow will be there in the economy, and finally boosting the economy and the GDP. Co-lending, also known as co-origination, is collaborative lending arrangement involving multiple lenders to extend loans to borrowers, right? Example, a business need a large sum of money for a business project. Now instead of relying solely on one bank, two financial institutions, let's say a bank and a non-banking financial company, that is NBFC, join forces to provide a loan. This collaborative approach helps to spread the risk between the two lenders while increasing the overall amount of money available for the lending. So co-lending allows borrower to access larger loans while diversifying the risk of the lender. So if this particular borrower fails to repay and the loan turns into NPA, then the risk gets divided and also the huge sum of money can be given. As per RBI, banks and NBFCs can co-lend loans to priority sector. We have already explained what is the business model of NBFC. They issue bonds and they raise funds and then they lend money to the market. With a minimum 20% credit risk on NBFCs and the rest on banks, banks are not allowed to enter into a co-lending arrangements with an NBFC belonging to the same promoter group or belonging to same promoters. Credit deposit ratio, we have already understood how much deposit is there and how much credit is being given. Banks in India are facing challenges in attracting deposits during the financial year 23-24. According to data from the RBI, the credit deposit ratio indicating that the proportion of banks deposit base used for loan has reached its highest level in at least 20 years due to increase loan uptake, particularly in categories like home loans and other consumption loans. Currently standing at 80%, the credit deposit ratio is at its highest since 2015. Why credit deposit ratio should not be high, very high? Because one thing we have understood that the bank borrowing, that the credit money or the loan that bank has given, it's not the bank money, rather it is a money of depositors. So there are some reserve requirement. We have already seen at some point of time cash reserve ratio, statutory liquidity ratio, etc. So there are some reserve requirement. Reserve requirement means that amount you cannot lend as a loan. So if credit deposit ratio is high, that means what proportion of total deposit has been extended as a loan. That is what we need to understand. Customers are opting out of opting for high return equity linked products, reducing the funds available for deposits in the bank. When share market is having highest volume, etc. So people are not depositing money in the bank account. In financial year 24, while deposits grew by 13.5% to 204 trillion rupees. The trillion, when in rupee we say trillion, that means lakh crore, right? Lakh crores, right? 204 lakh crores. Non-food credit grew by 20% to 164 trillion rupee, outpacing deposit growth. This contrast with financial year 23, where deposit grew by 9.6%. And this is not that much important. The credit deposit ratio is a financial metric used to assess the relationship between a banker's lending activities and its deposit base. This is what we have already understood. It is calculated by dividing total loans. We have already understood. A higher credit deposit ratio search, why it is not feasible or not why it is not not a good sign. This is what we have already seen, right? It is important measure of bank's liquidity and lending capacity. Fine, this is done. Now gross fixed capital formation. Gross fixed capital formation, it is how much we are investing in capital, right? That means in building infrastructure, in building schools, in building hospitals. So capital formation, that is what do we mean by capital formation. And also with respect to for example, you are extending loan to somebody. When you are extending loan to somebody, you will be earning interest on that. That is also a capital, right? So gross capital formation. Now private investment in India measured by gross capital formation. Here what you can understand when we say gross capital formation, about industries, about machines that we are investing in, right? Infrastructure can also be part of it. As percentage of GDP has seen decline since 2011-12, despite government efforts like corporate tax cut, private investment hasn't picked up. Private investment, the firm, for example, when we study about the primary factors of production, so there are four things, right? Land, labor, capital and entrepreneurship, right? Land, labor, capital and entrepreneurship. So investment in entrepreneurship, right? So when we talk about capital, this capital, continuous flow of investment will lead to capital formation only, right? Investment will lead to capital formation only. So that is what we are talking about. Gross fixed capital formation measures the growth in fixed capital in an economy. For example, land and other equipments, including assets like building and machinery, etc. It serves as indicator of private sector investment willingness and include government investment also. Gross capital formation is important because fixed capital boosts economy growth by increasing productivity and living standards. Developed economies tend to have more fixed capital per capita compared to, per capita means per person. And anywhere if you come across this word per capita, that means we are talking about per person. Example, if we talk about GDP per capita, that means what we are doing here, we are dividing GDP by total population. So that is GDP per capita, right? Per person. Capital formation, gross fixed capital formation and inventories, that is change in stock. In both these will result into capital formation only. Historically, private investment surged after 1990s economic reforms but dropped post 2008 financial crisis. It peaked at 27% of the economy in 7-8 but declined after 2011-12, reaching a low of 19.6% in 2021. Reasons of this decline: private investment decline is contributed to low consumer spending, poor government policies and uncertainty. For example, frequent change in this GST slabs can also be one of the reason, right? So there are many reasons associated with it. Frequent change in policy, textile sector, for example. So those things prohibit or make the environment uncertain with respect to investment, and that is why we see these kind of situations, right? Now, compulsory convertible debentures. Debentures is a debt instrument in financial market. Debt instrument in financial market. That means it is used to raise fund in the form of loans, right? In the form of loans in the financial market. The Competition Commission of India has approved the International Finance Corporation, that is IFC subscription to compulsory convertible debentures of Napino Auto and Electronics Limited, Napino. So sometimes what happens, debenture can be converted into shares also. So when debenture is a debt instrument, but when we talk about shares, shares is an equity instrument, right? You will be having ownership rights. So it is an equity instrument. So debenture means when you can convert that. When we say convertible, that means you can convert debt instrument into equity instrument and vice versa. IFC, established in 1956, aims to promote economic growth in developing countries by fostering private sector development. Compulsory convertible debentures are debt instruments that can automatically and mandatorily converted into equity after a specific time period when certain events occur or when certain events occurs. Hybrid instruments that are debt when issued but are guaranteed to be converted into equity at a later stage. Help companies repay debt without spending cash and benefit investors by offering fixed interest and later ownership of the company share, because when you raise debt instrument, that is when you receive interest, right? But when you have shares, then you receive equity, right? So this is where we will stop right now, and we'll continue few more topics in the next video. So stay tuned to the channel of Victory IAS to receive more current updates with respect to this prelims 2026, right? So stay tuned to YouTube channel of Victory IAS. Thank you very much. Bye bye.